today's discussion was just to see those things which we have not seen in our lifetimes. And in the history of financial world, we forget the history very soon because history is there in charts, and very few are adept to understand the technical analysis, that how much did the stock perform in that particular time. So history is coded, I would say. So we are just going through the history, and we are trying to understand the global economy in 2023. And we will go through the history of stock market crashes so far. And this is from an eyes of an average retailer, which is us, me, I would call myself as an average retailer. And I started making this presentation on in the beginning of the September, and could complete it by 25th of September by gathering all the facts. And just for my memory, Nifty was at 19674 on that date. So, with full disclaimer that I am just a human being and I know very little, and there is a vast knowledge in the universe which I don't know that I don't know. So, we are today understanding, are there risk factors for a global recession coming in 2023? So we have to understand the difference between stock market crashes and corrections. So corrections are 15 to 20% corrections, which are healthy and which give us opportunity to join in the long run if we have missed a rally. And but we are talking here about the stock market crashes. Crashes by which we mean that there is a 50 to 60% drop in the index. And in the individual stocks, there could be a drop of 60, 70, 90% as well. So we are talking about big crashes here, and we are just studying the history of these crashes. To start with a quote from Howard Marks that we have to practice defensive investing since many of the outcomes are likely to go against us. It's most important to ensure survival under negative outcomes than it is to guarantee maximum returns under a favorable ones. And then I want to quote Benjamin Graham that the market is like a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. So the intelligent investor is a realist who sells to the optimist and buys from the pessimist. So as we are saying that market is like a pendulum, and we have to figure out today, हमें ये नहीं पता कि future क्या होगा, but we have to find out that where are we standing today right now. So let's go to the past history of crashes. And the average bear market has lasted for around 349 days, and the decline has been around 35%. This is the average bear market. History doesn't repeat itself, but it often rhymes. And in 2023, we have to understand what are the risk factors that can lead into another recession. So we are studying here five major crashes of the history. That is 1929 stock market crash, 1987 Black Monday crash, 1999 2000 dot-com bubble, 2008 financial crisis, and 2020 coronavirus crisis. And we will understand कि कैसे एक domino की तरह सब कुछ चालू होता है, that one things fall and then rest of the things also start to fall, and there is a black swan event in the history. So what happened in 1929 crash? So there was a massive bull run in the market from 1920 to 1929, and finally in October the crash started, the capitalization started, the mega selling started in the New York Stock Exchange. Right, it is considered as the worst recession so far, and it was called as the Black Monday. It was October Monday, and that's when it happened. And Rockefeller family and other financial giants, they tried to buy a large amount in stocks to demonstrate to the public their confidence in the market, but their efforts failed to stop the large decline in the prices. So the fall was very extreme. The fall was around 60% market fall happened at that time. Then coming to the 1987 stock market crash, again it was a Black Monday in the month of October, and we saw selling of nearly 10%, and then 25%. In 16 days there was a fall of around 25%. So in 1987, let's talk about our Sensex. I couldn't find the Nifty data of 1987, but Sensex was there, and the Sensex crashed from 36%, and the bottom was made in over 640 days. And to let you all know, Nifty was just taken, I mean, the Sensex was just taken aghast. There had been a bull run for a very long time, and the market were at its top. when the market started following. And the full recovery after the major crash of 1987 of October, it took full 2 years for the market to come back to the same level. So what happened in 1987? So there was declining dollar and trade deficit. Yields on the bond was there. The market was overvalued. There was portfolio insurance. There was computer trading, margin securities had started, and all this was to the crash of Black Monday 1987. Right. So possible explanations for the initial fall in stock prices included a nervous fear that stocks were significantly overvalued and the correction was imminent. And I have added a lot of details about what exactly led to the 1987 crash here in my slides, which I will share the link with all of you. And there is also another slide which I have added from William O'Neill, that how we could have suspected the days of distribution. There were four major days of distribution on the NASDAQ composite chart, and how it broke 50 days moving average, and how we could have got suspicious about the imminent crash coming in. In 1992, India saw Harshad Mehta scam, and there was a 53% correction in Indian equity markets, and the bottom took 456 days to form. So it took more than a year for the bottom to form, and then subsequently the recovery did start. Then we are coming to the 1999 crash or the dot com bubble, which the graph is matching the current tech bubble as of now. And if we compare the graph talking about the 1999 crash, at that time the equities had raised to 776% from 1995 to 2000. And there is similar kind of tech bubble right now, where from 2016 till 2021 peak, there has been a 292% advance in the uh, equity market of these tech tech companies. So the rise and fall of 2000, why all this happened? This all happened because people got really speculative. They thought that the internet and the dot com all this will change their lives, and because of this speculation, there was a crazy bull market from 1995 till the peak of 10th March 2000. So in the dot com bubble, Amazon and all the dot com companies started coming in, pets.com, and what they found after the results was that many of the companies got bust. They were not giving good results. They were not profitable. They had taken a lot of debt, and venture capitalists then started selling. Again, there was a prick in the bubble, and there was a panic, and then uh, the bubble got busted. So I've added the graph of Nasdaq 100 or the weekly chart of the tech bubble, and we can see that there was a drop of 82% from the peak in the Nasdaq to make a bottom. So it took 82% drop, and it all happened over 924 days. So around 3 years, the bottom, it took around 3 years for the bottom to form. And talking about the Nifty, so Nifty from its peak had fallen by about 53% in the dot com bubble, and the bottom took 1,217 days to form. So we have to try to understand that whenever there is a global crisis, especially in the American markets, we are not left behind. When the Titanic sinks, we also sink along with it. Then we talk about the 2000 March 2000 Ketan Parekh scam. And there was a 55% corrections in Sensex at that time over a period of 1126 days, right? It took around 1100 days for the bottom to form in the Ketan Parekh scam. And his modus operandi, we all know about how the same stocks were manipulated and traded in his nexus. Percent crash at that time in the Ketan Parekh scam. His stocks were the favorite stocks like Satyam Computers, Silverline, Ranbaxy. These were the stocks which he was trading into. And there's a book I have quoted, Santosh Nayar's book, Bull, Bears, and Other Beast, which is the story of the Indian stock market, which is a lovely read. In 2008 came the great financial crisis, in which there was a housing market bubble going on in America, in which they were giving subprime loans to people who didn't have stable jobs, and they were not stable people who had a lot of sources of income. And because they were getting higher interest rates on subprime loans, they started giving such loans to people. And the Lehman Brothers declared their bankruptcy, jobs were lost. Obama's economic stimulus plan was then started later on for the recovery of the crash. So the main cause of the bubble of 2007 was housing market. So S&P 500 corrected over nearly 2 years, and then it came down from 1,450, 1,500 points to below 800 points. So it was a big correction in the housing bubble of 2008. So what happened at that time in Nifty? Nifty at that time corrected over a period of 434 days, and 64% correction came in the Indian stock markets because of the housing bubble crisis of America. So it was again a global financial crisis. Always remember, America is the mother of all economies, and we are 9 times younger than them. We are a $3 trillion economy. They are $27 trillion economy. So Nifty saw 62% correction over 434 days, and that is when the bottom had formed. So after this crash, it took 4 years to recover to the same level. So that is why we are again we have gathered here together today, because if we are sensing such kind of crisis, and if we have bought our stocks which are very expensive at expensive valuations, then we have to be cautious. And after it took a 4 year recovery, that is sorry, from the tech bubble, it again got a crash in 2008. So next, coming to the latest crash, which some of us remember, if we were invested in 2019, 2017, like I started my equity investing journey in 2017. I have shared before that I didn't knew spelling of stock market. I was just an accidental investor at that time, and I didn't really understand what's going on. And to be lucky that I was really busy, I'm a doctor, I was working, I was really busy working during the COVID days. I was not in my country, I was working in UK, and I didn't have time to touch the stock market. But I wanted to go through the history. So again, I took out the charts of 2020 crisis. The crisis came, there was a crash of 38% in Indian Nifty. And from the peak, again, it was at the top. At the top, there was a sudden correction, and it took 49 days. So this was the smallest ever recession period that we have seen in the history. There was a V-shaped recovery, and this is something rare, which happened during the times of the COVID. So, and we also want to know that what happened in a single day. So in the COVID coronavirus outbreak on March 12th, we saw a 9.9% crash on a single day on Dow Jones. And in 9/11, we saw a 7% crash. So like we have seen in the history 7 to 10% crashes in a single day. And let's talking about Indian equity markets. So we also have seen crashes between 5 to 13% on a single day. On 23rd March 2020, we saw 13% crash on Nifty. On 28th April 1992, in the Harshad Mehta scam, we saw 12% correction in one day. On 24th October 2008, when there was a US financial crisis, we saw a correction of 10.95% in a single day in India. And there's a table which I have attached here, which you'll be able to see. So biggest single day crashes have been anywhere between 5.9% to 13.5% in the history of Indian stock market as well. And over 16 days, the biggest crashes have been 33% in 16 days in the Wall Street crash of 1929. And in 1987, there was 31% crash in 16 days. In end of gold standard 1931, there was a 26% crash. So we have seen only within a 16-day period crashes of 8 to 33% in 16 days, right? And we have to understand that it takes a time to recover from those bottoms, right? So I have added some more slides of single day crashes. For example, 22nd May 2006, when Congress came to power, and there were many other reasons when the Sensex had plummeted 1,000 points in one day. So stock market crashes are rare, but then when they come, they just wipe off the whole capital, and it is very difficult to face them if we have not been cautious, if we have done some reckless mistakes. So we have a indicator, right? We have DCBA indicator, or let's say ABCD indicator. ABCD along with inflation and uh, along with the interest rates, which we will be talking about. So D stands for dollar index, C stands for crude oil, B stands for bond yields of the US government, A stands for American market indices, that is Nasdaq, S&P 500, and Dow Jones. So where are we in front of India to start? Where are we in front of America? I want to start with that. That when a big ship sinks, it takes away with it all the small ones. America is a $26.85 trillion economy, and we are $3.74 trillion economy. We are really small in front of them. So, what is happening in the dollar index right now? There's a weekly breakout on the dollar index chart since 25th of September. Even before that, there's a golden crossover on the weekly charts. 10 months, 10 weeks moving average has moved above the 30 weeks moving average, and the prices are above both of them. Dollar index as of 12th of October, we have that yes, it is at the breakout level of 105.74. Prices against the dollar are weak, and that is why the dollar is standing tall. And the crude oil prices, they are getting very expensive. So whenever the crude oil prices increase a lot, we have seen that there is a long history of oil prices, and we see that there is there whenever the oil gets very expensive, it is very bad for the economy, and we are seeing a fresh breakout in the prices of the crude oil. On the weekly chart, we saw that breakout around 5 weeks ago, and the crude prices have been steadily crawling up. Now, coming to the B, that is bond yields, and US government 10-year bond yield are now at 2007 levels. A bond yield graph, if we see the yearly graph, it is very interesting. The bond yields had been just falling and falling and falling from 1980. And now we are seeing a turnaround. It is a multi-year breakout, multi-year U-turn in the yields of the bond market, which is so surreal, which we have not seen in the last 40 years, right? This is really different of the times of what we have lived in the last 40 years. And we get a lot of insight from reading the Harvard Marks memo, which we can see on the Oak Tree Capital website, which he manages. He manages $150 million fund, and his memos are really really interesting. He's also the author of the book Most Important Things and Market Cycles, and one must read these two books and his memos to understand what he's trying to say. Again, the US Treasury 2-year government bond yield is at 2000, 2007, and 2008 levels. And the most interesting part is that the short term bond yields are more than the long term bond yields. And this is a very, very important economic indicator in which we have to understand that whenever there is inversion of the bond yields, there is a recession coming in. In the past years, whenever the bond yield ratio has inverted, that is, the short term treasury yield is more than the long term treasury yield, it has been a very strong indicator of a recession coming in. The same thing happened in 1980s, 1990, 2000, and 2010, and now happening in 2020, when we are seeing there is a bubble in the stock markets. So 2020 it happened, and now it is again happening today. So last four times the 10-year minus 3-month treasury yield led to 1990 recession, dot-com burst, global financial crisis. History doesn't repeat itself, but it often rhymes. So inverted 90, and we long we will be able to hold on. So bond yields going up, stock market also standing up is not the normal thing. One thing has to break, something has to break here, right? So Buffett, what is Buffett doing right now? So Buffett, we need to pay attention what Warren Buffett has done. Warren Buffett is sitting on a 147 billion pile of cash, and right, he has shifted money to the treasuries bonds. Continues to park most of the Berkshire's money in U.S. treasuries, right? That's what he has been doing. So Berkshire Hathaway's cash pile near all-time high at $147 billion. That was published in Berkshire Hathaway Inc. and in on 5th of August 2023. So there is a chart of the world indices, and we see that Many indices of the world are showing weekly. On the weekly chart, there is a strong sell signal. I've taken this from investing.com, and India is still at all-time high, and we don't know when we will join the other countries. But as we have seen historically, India is always till the all-time high and it joins very late. Now, Bank of Japan has also kept the interest rates very low, which again keeps the dollar very strong. Now, some important dates to remember, that is the VIX expiry and the option expiry. So, 18th is the VIX expiry day of the US stock market, and 20th of October is the option expiry day. It is the option expiry day of 20th, right? So these dates are important, 18th and 20th of October, and same dates which will be in November, and that will be the third Friday of November. That would be the 17th uh, November. Yeah, so these are some important dates where the option market expires. So FIIs have been relentlessly selling from the equity markets since 2021. And we have to understand that these things are done very silently. They are not told on the news, otherwise it will create a panic amongst the investors. So FIIs have been silently been the net sellers. They have taken out 92,000 crores in 2021, 278,000 crores in 2022, and till now in 2023 they have taken out 29,000 crores. So we have to understand that they have taken out the most of it from the equity markets of India. And historically, whenever they have faced problem, we all had to join the drawdown. So, what could be the possible drawdown in the Indian indices? Again, these are possibilities, and they are just kind of probabilities and possibilities. So, if we draw a trend line above the Nifty 50, and we draw a trend line above the uh, pre-fall COVID level, and then we draw another trend line which goes through the bottom of 2016 and the bottom of 2020 fall. And if we draw a trend line, we can we can see that the possible drawdowns could be 26% if the crash stops at the pre-COVID fall level, pre-COVID fall level, and it can be maximum 53%, which can be the COVID low trend line. So we can see 53% fall in equity markets as well. Again, these are all possibilities. They can be 100% wrong as well. And I am I'm not an expert. I'm not from this field of finance. I'm just a simple consumer. I'm just a simple person who is a defensive investor who works really very hard for a living and wants to save the money and not to lose money in greed. So Nomura retains negative view on Japan on Indian rupees despite JP Morgan index inclusion. Rupee gives up index inclusion led rally, and RBI counted on to help, but rupee has been really not doing really very well against the dollar so far. And if we talk about the US dollar, Japanese yen, again there is a weekly breakout on the charts. Bankruptcy filings in the US, when the interest rates were low, the risk management was having a holiday time. Will it lead to a fall in the market? Cannot say with certainty if it will repeat, but surely there is a stress in the system. Financial world works on trust. Trust that money given will come back on the day promised. So bankruptcy filings have increased and they are to the level of 2008 and 2020 and 2023 right now. And we have to remember that majority of the declines in these bear markets occurred after the Fed had done the pivot, after the Fed said that okay, now we will not increase the rate. So history
This space was downloaded via spacesdown.com. Visit to download your spaces today.
shows this, that pivots will trigger the real crash. But again, we don't know. Fed had stopped the increase in rates in the this Fed meeting. They said that they will not increase the rates, but they don't know when they will start decreasing it, and maybe the increased rates are the new normal. And there's another chart that imagine that you are an FII, and you are now getting a Sensex earning yield which is lesser than the US 10-year bond yield. So why will you come to an emerging market like India when you are getting good returns in your own bond market? So we have to ask this questions to ourselves. And Again, it is very interesting, right, that the Sensex yield is 4.1% and the US 10-year government bond yield is 4.7%. So why will they come back to India, right? So this is one of the biggest reasons why FIIs and FPIs have withdrawn their money. And we really need to understand this, that we are overvalued, right? So Nasdaq on the weekly chart, it has broken the 10 weeks MA, and the next line of defense will be 30 weeks moving average. Only time can tell. This is from the Stan Weinstein book, The 30 Weeks MA, the stages that he follows, and from the William O'Neill, I understand and which I usually use in my investing. So chart, and again, this is there is again a Dow Jones chart that I have has broken the 30 weeks MA, right? So this 12th of October latest chart, and Dow Jones has broken the 30 weeks MA, and for last 3 weeks this has happened, right? So this is something to just be cautious about. And I have added a chart of the Stan Weinstein stage analysis about the distribution and the resistance zone. So this is something really interesting to learn. So we can trail the stop losses if whatever I'm saying, if you think that cannot happen. So I think the safest way to play defensive would be to trail the stop losses. Maybe that is one thing that you can do. We always have to remember to Yes Bank and how we retailers were, the stock that is falling is in the news so that we buy in in the Yes Bank. The Yes Bank after showing a 3,000% 400 and in 4,000 days again came back to those levels, right? After July 2018. So we have to remember that every stock moves like a pendulum. If it moves too quick too soon, then it has to come back. Imagine yourself on an airport, and what happens in an airport if you are walking on the walkway. So when you are walking on the walkway, you move faster than the others. But if everyone is walking on the walkway, you see that everyone is moving faster, right? So when everyone starts moving faster, we forget that we have got a lot of success in too little time. So that's what probably has happened in the US stock market, where there have been too low interest rates since 1980. And since 1980, the Fed had been decreasing the interest rates, and now they have started to increase the interest rates, which are to the surreal levels, which they have not seen in last 40 years. Again, we should not forget the history of Reliance Communication. What happened, right? Arcom, after giving a rally of 334% in 581 days, it corrected and came back to its bottom. So I've given some references of books which have inspired me to make this presentation. So the most dangerous thing, what Howard Marks says is to buy something at the peak of the popularity. At that point, all favorable facts and opinions are already factored into its price, and no new buyers are left to emerge. So Nifty PB ratio, again, this is very interesting thing. Till Q3, the Nifty PB ratio was 4.57, and now they have changed the way to calculate the Nifty PB ratio, and now it is falsely looking as a lesser PB ratio. Right, so we are still very expensive. Our PB ratio calculation method was also changed in March 2021, and that is why you saw the PE ratio fell suddenly from 40 to 32, but is actually because the previous calculation method was standalone earnings, and now they have changed it to consolidated earnings. So that's what it has happened. So as a long term investor, I think if you have bought at the peak, then there is something that you have to think about, because the drawdowns, if you just let their if you just allow 50 to 60% drawdown in your portfolio, then for that 50% drawdown, the same stock has to rise to 100% times, then on 100%, then only it comes to the same level. If you allow the fall of 65%, it has to rise to 185% to come to the same level. So we are not trying to time the market, we are just trying to understand where we are. And if we have bought very expensive, then we should be understanding these things. Again, from the 6th October update, we have a war in the Middle East, and again, this can possibly inflate the crude oil prices. And what we are seeing is that it can really go from bad to worst. It can last for times which we have not expected, right? So the strategic petroleum reserve of us is that is depleting, and it is really gonna be challenge for them to buy crude at such a high cost. It can only happen, the crude prices can only happen if a recession comes in and everything crash. So while we were talking, we saw that just 2 days ago, we saw the CPI inflation rate, which is still 3.7%, and the car insurance inflation is 18%, car repair inflation is 10%. Everywhere there is a inflation. There's a rent inflation, there's a homeowner inflation, there's a food away from home inflation. So there are many factors which are leading to the inflation, and we don't see that we will see that a sudden correction very soon. So something has to break here. So there is another very important indicator, that is the US leading economic indicator, that continues to signal recession after contracting for 14 consecutive months. So this happened in Jan 2001, this happened in Jan 2008, and this happened in Jan 2020, and this is again happening now, though the recession has not been declared. We are seeing that the bond yields are going up, and for an average person who has bought bonds previously which were at low interest rate 1% 2%, now he would be attracted towards the new bond yields which are 5%, which be selling the old bonds and buying into the new bonds. So this is very interesting, and the smart people, they have already started to move away from the equity markets, and they have started to move in the bond market slowly. And we just have to wait for that one panic day to come, that whenever this house of cards can start to fall, right? So we don't know when will this fall come. We can't predict that, only time will tell that. But we just have to hold on to the things. So markets today are unpredictable, so that one has to have different scenarios. The idea that you can actually predict what's going to happen contradicts my way of looking at the market. That's what has been told by George Soros. So there's a big difference between probable outcome. Probable things fail to happen, and improbable things happen all the time. That's one of the most important things that we can know about the investment risk. Again, I have a closing statement from Harvard Marks. So we have to understand that where we are, right? You want to buy before the mania, and you want to sell into the greed. We don't have to wait for a new paradigm that yes, it will keep on rising, it will keep on rising, I will buy more. So control your greed, have a strategic exposure to the equities, plan your ratios well, have your FDs, have your gold, have your different places for investment, and don't think that equity market is the only place that people earn a lot of money from. This kind of dysgenesis, that is the difference that we have created, is a bubble that everyone is going for equities, and we have to have a very balanced approach, right? Because if recession comes, they really bring a big drawdown. So since COVID fall, let's try to understand together where we are right now. Since the bottom of the COVID, Nifty is 166% up, right? Over a period of 1,300 days, Nifty has come up to 166%. The small cap index has gained 319% since the drop of COVID. The Nifty mid cap has gained to 80% from the bottom of the COVID. So there we are. We have already gained 166%, 319 to 80% in our indices so far, right? So bear markets, yes, most of us can't avoid, but there are signals which can tell us that what is coming ahead. There are some interesting movies because they help us to go in the history. Again, take them with a pinch of salt. After all, they are movies, but maybe you can just have a good enjoyment. That is, do see the movie The Big Shot, The Inside Job, The Margin Call, and two interesting movies to watch. My acknowledgements, my friend Dr. Hiren, understand all these things. Dr. Alok Chaudhary, some good Twitter handles, trades, Corbesi letter and Swordfish and bar chart, which really give good diagrams and good data from the past, which have helped me to understand what's going on in the equities in US. And I think we are a very small economy in India, and we won't be untouched. So the bottom line is that learn the fundamentals and technicals, understand basic macroeconomics and geopolitical situations. Don't be greedy. Market runs in cycles. It's like a pendulum. We are not timing the market here, but we we are trying to understand, to know where we are. Sometimes equity, sometimes debt, sometimes gold. Always keep cash in hand. Invest 100 minus age into equity. Like for a 40-year-old man, invest 60% into equity, which is applicable to most of us. Risk management is the key. One can continue with their mutual fund SIPs because, again, we don't know what we don't know. But if you have individual stocks which are overvalued, just discuss with your financial experts. And I think it's always best to study on your own because, again, we don't know what they don't know. And hope for the best, but be prepared for the worst. So that's all how I would like to close this. And I would request accidental investor to ask some questions and we can discuss. Hello, Prince, are you there? uh yeah. So yes, I have approved. Yes. Yeah. Yeah, Prince, can you hear me? Hello, Prince, are you able to speak? Can't hear you. You have to turn on your mic.
Yeah,
You have to turn on your mic. Yeah,
I
yeah,
was
yeah, yeah.
I was not speaker that time, so I
Okay,
appreciate.
sorry. I have added you. Yeah, yeah, yeah.
Yeah. So first of all, I would appreciate the hard work you have put in so as to make this presentation, and very relevantly you discussed all the points which need to be taken care of. As you rightly said, we never know what can happen in the market, but it is always wise on our part so as to gauge where we are in the market broadly, right? So with that,
Mm-hmm.
so the base, if we
Hi,
compare
am I audible?
whosoever is speaking in between, please wait for some time. Let me complete, then we can name you guys as.
Yeah.
In context of India, so how had been like it was there in comparison to the West as far as global financial crisis were concerned. So don't you think we are in it? Obviously, we cannot say that if US falls, we will not fall. But don't you think we are better placed in comparison to other countries, especially?
Yeah. I think we are definitely better placed than other countries. But our only concern is risk reward. Like we are at the peak right now. We are at all-time high right now. So the question is that where is the risk more? Is there a more reward of going more higher and higher from here, or is there a risk of going below from here? So while I am talking, I have opened the Nifty chart in terms of dollars. And when you compare the Nifty chart in terms of dollars, what you see is that Nifty in dollars is at the same level where it was in September 2021. Because of the rising dollar index and because of the interest yield, the bond yields that they are getting better than us right now. So they have to have a very good reason to come back to us. So if we compare Nifty in dollars, we are exactly at September, October 2021 levels right now. And right now, let's say it's $237. So we are exactly there for them since the last 3 years. So nothing has changed, nothing has, drawn their interest so far beyond this level. They have been net sellers beyond this level. This top has acted as resistance for them.
So, in want of whatever situation is happening across, how you are placing yourself as far as your investments are concerned? Are you going in cash or you are simply
So
retaining?
I am very defensive right now. I have continued my mutual fund SIPs. I've not drawn anything from there because, as I said, I don't know what I don't know. I'm just a common retailer, but I'm definitely following the rules. My equity exposure right now is only through mutual fund SIPs. I'm not into individual stocks because I think many of them are overvalued. Even the large caps which I had overvaluations. So I'm out of all the overvalued stocks, and I think most of the ones in my portfolio were large caps and were overvalued. So I'm out of them.
All right. So maybe we can take Rakesh's question and then we can take further question. We are
Yes, of course.
left at last 15 minutes, I guess. So
Yeah.
Rakesh, you can unmute and ask the question.
Yeah, can you hear me?
Yeah. Hello, Rakesh ji.
Yeah,
Hello,
hello,
sir.
hello. See, the yield curve flattening, then even the US cars freight index, which is actually negative year on year, then the whole housing thing which is happening because of the mortgages and all, they all are
True,
telltale
sir.
signs of a recession in the US. Now we have to
Right, sir.
understand one thing, that $3.5 trillion of American money is invested in China.
Right,
Politically,
sir.
China and America are at loggerheads now. And after
Mm-hmm.
COVID, the Americans actually realized that the overcoupling which they have done with China is actually going to harm them in the long run. Now they have started doing a course correction. How much they'll be able to actually achieve out of it, nobody knows. Now, my question as well as comment is, out of this 3.5 trillion, which will be slowly removed from the Chinese market by the Americans, probably because Wall Street will be pressurized by the main street to do so. Will some of the money at least will come to India, or it will be again put back into treasuries only? Because somewhere they need to get the money to balance their debt, no? At least for the short term. From where that money is going to come? They can't keep on printing, and that will lead to more
Very
inflation.
true,
So
sir.
what is going to happen in that situation? Can anybody, means whoever, you can take it?
So what I feel is, sir, they will come back to India because India is the best option to them. But at these levels where India is right now, we are at the same levels at September 2021. So probably they will wait for a value to come in India. Probably once the correction happens, and once we are again at a value buy for them, let's say below $180. Again, I'm talking of Nifty in US
Hmm.
dollars, below
Hmm.
$180 at around 160, $150, maybe they might find value between anywhere between 160 to $100. They might find value in Nifty, but at current levels, it's a question
No,
mark.
but you see, $180 also corresponds to 15,400 Nifty. Now,
Right, sir.
even if you see the very long term chart of Nifty, weekly chart from 2020, the
Right, sir.
it is making a higher lows.
Hmm.
Agree, no?
True, sir.
So if something is making a higher lows, unless 15,181, that was the low, right? After Putin war, right?
So
That,
after
unless that
so
is,
pre-COVID, the pre-COVID for rise was
huh,
$175, and the post-COVID bottom was around 97 to $100.
correct, correct, correct. So that is unrealistic because um, our SIP guys are putting $2 billion a month, and that is
Hmm.
eventually going to come back in the market only. No, they are not going to be investing in commodities
Right,
and all, because
right.
ninety
The only
percent
thing is, sir,
funds, ninety.
when panic comes, will SIP come? When panic comes, when the jobs are less, when we are in a recession,
No, we are not going to
are
go
we
in
solely
recession.
relying
Sorry,
on
sorry,
that
sorry, sorry. We
SIP?
are not going to go in recession. It is the American economy which will be
Uh,
going in recession.
Historically, what we have seen is that whenever they have gone into recession, it has
No, it has
affected
affected growth
the
and all,
emerging
but
markets as well.
recession means negative growth. Now, we are not going to ever going to go through it, at least for
I'm talking about the drawdowns.
drawdown.
I'm
Acha,
talking
acha.
about the
Huh.
drawdowns. So historical
I thought you
drawdowns
were
in the
talking of GDP growth.
indices,
Sorry, sorry.
right? So historical drawdown of the indices in the markets
Hmm.
have been very much equivalent or more than the drawdown that they have seen.
Hmm.
That's historically
Also,
in all the recessions since 1929.
okay, and you have also seen, I believe, Nasdaq charts and all, and you are saying that they are all trading at
Yes,
below
yes.
30-week low, right?
So, not Nasdaq
Sorry,
right now.
Dow
Nasdaq
Jones.
is below 10 weeks MA, but Dow Jones, yeah. So Dow Jones is below 30 weeks MA right now.
But are the Americans not able to understand this? That how is this going to end? Yeah, just like 30 billion dollars a week. their their
So I have
their
few friends here. I have few
hmm,
friends here who are experts in financial markets in
hmm.
America, and I think maybe they have not been able to join right now because the timings are
Correct,
different.
correct.
But I hope that once they hear what we discussed, maybe we will get their inputs as well. So what they say, what I have spoken so far to some experts, they're like Fed has been at a wrong place since 40 years because they kept on decreasing the interest rates. So the interest rates have been nearly zero since 1980. They had been decreasing the
89,
interest rates
precisely since
since
1989.
1980.
89.
1980. I'm opening the charts right now of the dollar
No,
yield of the 10-year US bond market yield, and since 1980 they have been decreasing the
they have been
interest rates.
decreasing, but they became historically zero after Alan Greenspan became the Fed
Yes,
head.
yes, yes,
That
yes,
happened
yes,
in
sir. But from
1989.
their top, true,
Senior
true,
George
true,
Bush
true, sir,
appointed
true.
him, and that's the time.
Very
Uh,
true,
but anyway, that is also
very
still a
true,
very
sir.
long period, no, for zero interest rate.
Yeah, very long period, sir. And I have just opened the chart of
Now,
the
now
US
there's another
Treasuries.
bit of statistics I want to share. That you see in
Yes,
US,
sir.
50% of the money is invested in equities. In our
Yes, sir.
country, that right now is just 15% or even less than that. Now,
Right, sir.
assuming that we follow the US, it's an assumption. If
Yeah, that's an
our guys
assumption.
also
Exactly.
increase equity exposure, our middle class, our everybody, and so will the market still fall? I mean, it's little bit of a
Again, sir, only time will tell. Only time will
okay,
tell.
okay.
We can only be
We can only
prepared
be
for
prepared.
the worst.
Fine, fine.
And
Understood.
I think what we can be best prepared for the worst is that we should understand the valuations of the businesses we are owning, the stocks we are owning.
Correct, correct.
And if we see that the valuations are too high, they have
Yeah.
skyrocketed too much in too little time, then we have to be defensive.
Yeah, those
That's
are
what
the
I
ones which
feel.
will fall very badly. Correct, correct.
Exactly, exactly. But the thing
Absolutely
is,
correct.
sir, whenever the index falls 50%, everyone falls.
Oh, that
So
is
what we have seen historically that if the indices fall 50-60%,
correct,
the
correct.
individual small caps would fall 90%, the large caps
That's
would fall
that's
60-65%.
that's how
So I mean,
professors
see,
started preparing.
when the market falls, it creates opportunities, and when
Correct.
market
Of course,
appreciates, it creates
of
value. So
course.
it's up to
Of
individuals
course.
how do
So
their
we might get a value which we have not got in a decade, but as a common retailer, we have limited
Hmm.
capital. We are not mutual funds that are having a, incoming of big capital every day. So we have to understand that where we are in the market cycle right now. So market cycles are something which
Bubbly.
are there,
Yeah, minted.
we have to understand. So we are at the peak right now.
Minted. Thank you so much. Thank you so much. Thank you so much. You can remove me from
Thank
the
you, sir.
speakers
Thank you so
post
much
now.
for your input.
Thank you. Thank you.
Thank you, sir. Thank you. Right, Prince. Any other question that we are seeing?
I think we pretty well covered the topic holistically, and
Right,
I think
right, right.
we can have a subsequent session as and when market demands.
Sure,
So
sure.
thank you for
We can have a 1 month follow up to our discussion and see where we are from here. So let's say around 15th of November we can discuss again.
surely we can, and
Surely.
definitely we look forward to a possibility of an offline session at Jaipur, right?
Yeah, yeah, great. Thank you
So
so much, Prince. Thank you so much, everyone, for joining. And we would be happy for the chats later on. Thank you so much, everyone.
and let me give a shout out to Dr. Srishti, who has been very positive and energetic in sharing her thoughts. And obviously, as she always says, these thoughts are individual, by no means so as to influence anyone, but just so as to give a thought process from where you.
Yeah. And I think to conclude, I would say that please read oaktreecapital.com and read the memos of Howard Marks. Please do read his memo of 11th of October. The new ocean, the new sea. I think it's a very, very interesting read. And you all would understand that what I'm trying to talk about. So please read further thoughts on sea change. I will be attaching the link to the chat box.
We can only pray that भगवान अमरिकियों को बुद्धि दे. Thank you
Oh
so
yes,
much.
sir. I think they, yeah. And sir, another book that Ray Dalio's Changing World Order. So very beautifully he has studied history. I think he is one of the people because of which I was intrigued to read through the history of the crisis of financial stock markets, because they are encrypted in these charts. And Ray Dalio has said that the US is on a decline right now. That China is on rise, and yes, we are at a sweet spot, and we will come again as a sweet spot. I think we should be the first ones to stand again after this shakedown, and we should have some sane amount of money to take part in this drawdown. We should not be greedy, and we should have a balanced approach right now. Yeah.
Thanks, guys, and
All right.
surely you can connect with Dr. Shrishti and this handle Jain Equity Yarn. So definitely much more to come on knowledge part from these handles. Thank you so much.
All right, thank you everyone. Thank you Rakesh sir for your inputs. Thank you everyone. Okay.
This space was downloaded via spacesdown.com. Visit to download your spaces today. 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 Download